You know, it's this puzzle that millions of families face every single year. You've got one child, multiple adults who love and care for them, and literally thousands of dollars in tax credits hanging in the balance. Getting it right is a big deal, and getting it wrong, well, that can be a costly mistake. Today, we're gonna crack this puzzle wide open.
Yeah, that's a question we hear all the time. And look, it's not just about divorced parents. It could be a child living with grandparents, or maybe a young mom who lives with her own parents. The stakes are incredibly real, and the answer, well, it's almost never what you guess.
So this is the heart of the matter, right? When more than one person could technically claim a child who actually has the legal right to do it. The IRS isn't gonna let families just, talk it out, no way. They have a very specific, almost machine-like set of rules to figure out who wins. And let's be clear, we are not talking about small change here. Things like the child tax credit and the earned income tax credit can add up to thousands and thousands of dollars. We're talking about money that can completely change a family's financial situation for the year. So understanding these rules isn't just nice, it's absolutely essential. All right, so to make this super clear, let's walk through a real-world scenario. We're gonna follow this case from start to finish. We've got Tasha, who's the mother. Then we have her parents, the grandparents, who also help care for her little boy. The key detail, they all live together under one roof. So the big question is, who gets to claim him? Okay, so before you can even get in the game, the IRS has set up these 4 big gates. Think of them like checkpoints. A child has to pass through every single one of these gates for you. If they don't, you're out. It's as simple as that. All right, gate number 1, the relationship test. This one's pretty straightforward, There just has to be a clear family connection, and it covers all the usual suspects. Your kids, stepkids, grandkids, nieces, nephews, you get the idea. Next up is the age test. And this one looks simple on the surface, but trust me, it's got a twist. It's not a one-size-fits-all rule. A kid can be too old for one credit, but just right for another. Keep that in mind because we're gonna circle back to it. It's important. Now this next one, the residency test, is a huge deal, a really big one, especially if you're dealing with any kind of shared custody. The IRS basically wants to know, where did this child lay their head at night? And the magic number is more than half a year, which means you gotta count at least 183 nights. And the last gate, the joint return test. Basically, if the child is acting like an independent adult, they're married and filing their own serious tax return to claim their own benefits, then sorry, you can't also turn around and claim them as your dependent. Okay, deep breath. So let's imagine a child has passed all 4 of those gates. We're in, right? Well, not so fast. Remember that tricky age test I mentioned? This is where it gets really interesting, because the definition of a qualifying child actually changes based on the specific credit you're trying to get. Just look at this breakdown. For the child tax credit, the CTC, the kid has to be under 17, period. But jump over to the earned income tax credit, the EITC, and suddenly they can be under 19, or even under 24 if they're a full-time student. It's totally different. And check out the ID rules too. Some credits are super strict about needing a social security number, while others are a bit more flexible. So here's the bottom line. Let's say you have a 17-year-old high school student. For the child tax credit, nope, sorry, they're too old. But for the earned income tax credit, absolutely, they could qualify. See, you can't just ask, is this my qualifying child? You have to ask, is this my qualifying child for this specific credit? All right, this is what we've been building to, the real heart of the puzzle. What in the world happens when a child passes all the tests for 2 or even 3 different people? That's when the IRS steps in with the tiebreakers. And this is exactly Tasha's situation, right? Her son passes the test for her, the parent, and for her parents, the grandparents. He's related to all of them. He lives with all of them. He meets the other tests for all of them. So, who wins?
Okay, if you remember one thing from this whole explainer, make it this. The IRS tiebreaker has zero emotion. It doesn't care who needs the money more. It doesn't care about what seems fair. It is a cold, calculated, mechanical process, a hierarchy. And knowing this hierarchy is the key to solving the entire puzzle.
So here's how it works step by step. Rule number 1 is the big one: parent versus non-parent. If one of you is the parent and the other isn't, the parent wins. End of story. Now, if you have two parents who aren't filing together, then we go to rule number 2. Who did the child live with for more nights? And only if that's a tie, or if neither of you is a parent, do we get to rule 3, which is all about the money. The person with the higher adjusted gross income, or AGI, wins. Okay, we have the gates, we know the rules for the different credits, and now we have the all-powerful tiebreaker hierarchy. We have everything we need. Let's finally solve this thing. So let's go back to Tasha's house. We've got all the pieces of the puzzle on the table. Tasha, the mom, her parents, the grandparents, and her 2-year-old son, Jackson. Everyone lives together. Let's apply the logic. Okay, so let's look at the facts. Tasha is the parent. The grandparents are, well, non-parents. Her son qualifies for and lives with both parties. Now we see here that Tasha has a higher AGI. But wait a minute, does that even matter? And the answer is Tasha. And it's not even a close call. We don't need to look at their incomes. We don't even get to step 2 or 3 of the tiebreaker rules. Why? Because rule number 1, parent versus non-parent, is absolute. It settles it right there, on the spot. As the parent, Tasha has the primary right to claim her son. So let's just boil this all down. What are the final rules of the game? 1, you have to master those 4 gates: relationship, age, residency, and joint return. 2, know the specific rules for the exact credit you're going for, especially those tricky age limits. 3, if there's ever a dispute, the tiebreaker hierarchy is king, and it starts with parent versus non-parent. And finally, number 4, document everything. You always want to have proof of residency and relationship just in case. And that kind of leaves us with a bigger question, doesn't it? For tax purposes, the government uses these super strict mechanical rules to define what a family is. For just 1 year, it's a black and white snapshot. But you have to ask yourself, does that rigid legal definition always match the messy, complicated, and colorful reality of who your family really is? That's something to think about.